Right, so welcome to Module 5. I'm really glad that you've made it this far. We've only got this module plus one more after this until we're finished, so we're nearly there. And Module 5 is probably the module that I love teaching the most. This is one that I really enjoy teaching with one-on-one sessions when I'm working with clients individually. And this is also one that I really love teaching in this course, because if you take on what you're going to learn in Module 5, you will build wealth really, really fast. And I've seen this happen year in, year out, where the people that take this stuff seriously and they adjust their mortgage accordingly and they put the stuff into practice, you build wealth really quickly. So that is my intention, is for you to build wealth, because we really want to affect generational change through financial advice. And one of the best things that you can do to affect generational change with your family is to know how to handle your debt, know how to handle your mortgage, so that you can get rid of it as fast as possible. Because once you've done that, you are really in a place to start building your wealth much, much faster than what you possibly can imagine. So that's why we, of course, love building strong financial foundations, because strong financial foundations is what will give us the platform to really launch from. And as mentioned previously, the better the foundations, the better the building is going to be. And I've seen people with weak foundations try to build their wealth, and I've seen people with strong foundations try to build their wealth, and there's no comparison. All right. So if you get the strong foundations part right, and admittedly some of that stuff is a little bit of hard work in there, but if you knuckle down and you get that stuff right, then trust me, you're going to get all the exciting stuff later on, and you're going to be able to look back on a lifetime of doing the right thing and a lifetime of growing your position to the best place possible, which will do amazing things for the next generation that you pass that on to. It will also do amazing things for you in your own retirement, for example, which is important. Right, so course program. This is just to remind you of what we've been covering off. First three modules were really mostly about you, and then these next, the module 4, 5, and 6 is about you really growing your position. In module 4, we looked at basically the different ingredients of your mortgage cake, the different ingredients that we have, and how and what they are. But this week we're going to look at how we put them all together, and this is where you're going to basically look at your fast track mortgage plan in conjunction with modules 4 and 5, and make sure that you have a really clear understanding of how you're going to operate your own fast track mortgage plan, because that is going to have a massive impact on your situation and your financial position. Right. Okay, so last module we talked about the ingredients that go into making your wealth cake, and you can't make a cake without the ingredients, but the ingredients are not the cake. Now, if I come to your house and you say to me, "Hey Jeff, would you like some coffee, and would you like some cake?" and then you serve me a plate of ingredients like what's on the screen there right now, I'm going to be looking at that and I'm going to be thinking, really? You think that's a cake? That's just flour and butter and eggs and I don't know, that other stuff that goes into cakes, right? And maybe next time you invite me around to your house for coffee and cake, I might find that I've got to get my hair washed that day or something like that. So I'll look to maybe just avoid having a bit more of your cake, because the ingredients themselves do not make a cake, but it's how you put those ingredients together that make your cake. But if I come around to your house and you serve me a cake like this, and you say, Jeff, are you free to come and have a chat, and we're going to have coffee and cake, and you feed me one of these sort of cakes, then I'm going to be looking for the next opportunity to come back to your place, because that's a cake, right? And that means that you have learned how to put the ingredients together to get the result. And it's the same thing for our mortgage, because lots of people have got the ingredients of their mortgage already. I've coached lots of people that have basically got all the right ingredients, but they're all together in the wrong combination. They don't know how to use them, and as a result, they don't pay their mortgage off any faster than anyone else. So module 5, objectives. We're going to be reviewing the ingredients. We're going to talk about the power of lump sum payments. We're going to talk about revolving credits and offset accounts and how to use them. And we're going to be talking about hedging strategies. And then I haven't included it in this video itself, but you'll see in the membership area there is another video. It's a sample video of a fast track mortgage plan where I'm going to talk you through the different pages of the fast track mortgage plan, so that when you look at your own fast track mortgage plan, you will understand how to interpret it and what it means for your situation. Right, so we're going to start off with exercise 1. So get out your worksheets for module 5, which hopefully you have printed off, and we're going to look at exercise 1, and that is what are some of the mortgage ingredients we talked about in the last module. So these are some of the different types of products, different strategies, different ingredients that we talked about for the mortgage cake. So if you take a couple of minutes to do that, just write down as many as you can. Doesn't matter if you don't get them all, because I'm about to put all the answers on the screen right now. Here they are. Right, and so these are the different ingredients that we've got to work with for making our mortgage cake. And all of these are important. They all play a part in paying your mortgage off faster. Initially, or firstly, today we are going to talk about number 6, which is lump sum payments, which is one of the most important parts of your mortgage cake, and then we'll move on from there and look at the other ingredients and how they go together. So firstly, lump sum payments. So this is about being intentional with your income. Right, so most people don't know where all their incomes go. Where all their income goes. And so this is where what I've found now from experience is that, often people are earning quite reasonable incomes, but they'll get to the end of the year and they don't really know where their income's gone, because they've basically spent money in the wrong way, right? And so basically often they will still pay for their essential spending first, which is great, but often they'll target lifestyle spending after that, and then whatever is left after that becomes their surplus, right? And instead, we should be working with this equation here on the right, which is income comes in, essential spending goes out, putting our surplus aside, and then whatever's left over after that can be lifestyle spending. Because otherwise, if we don't put parameters around lifestyle spending, it's very, very easy to balloon out, because we like spending stuff on junk. Okay, so if you've been in the habit of doing things on the left side there, where you're prioritizing lifestyle spending, then I'd encourage you to start living according to the right side, because that'll make a serious difference to your wealth position. So it's important to be intentional with income. Most people don't know where their income goes. If you have a plan around your income and how to spend it, you can make sure that you have a monthly surplus. So this is why I got you guys to do the the annual spending plan, right? So the annual spending plan is so that you could be intentional with your income, and you could decide how much of your income you are going to allocate to seed capital, okay? Because seed capital is really important. Just how corporations will get seed capital to build their business, you need seed capital as well to build your family business, because this is what this essentially is. This is essentially your family business, and you also need seed capital. And unless someone's going to throw that at you by winning a lottery or inheritance, which is unlikely, then you are going to have to create your own seed capital. So if you're able to save your monthly surplus or your seed capital for 12 months, then you now have an annual surplus. So without checking for a monthly surplus, most people don't even know that it exists. All right, so you actually have to be really intentional to create your monthly seed capital and put that in a safe bank account, because that is going to be your seed capital for growing your wealth position. And without a plan for your seed capital or your annual surplus, it's likely that you're just going to find something silly to spend it on, and as a result, you'll have nothing much to show for it. Even if you've done a great job of saving, if you don't have a plan for it, then it's going to disappear into thin air. So your plan for it should be lump sum payments, right? So learn to love lump sum payments. Learn to love annual lump sum payments. This is one of the best ways for you to build wealth, because doing lump sum payments creates equity, and equity is wealth. All right, the more equity that you have in your house, the wealthier you are. So to get the result in your plan, in your fast track mortgage plan, you need to more or less live to your declared lifestyle expenses, accumulate your monthly surplus, and then do annual lump sum payments. Now, why do we love lump sum payments? We love them because they're 100% principal. So when you do a lump sum payment, there is no interest component. You do a 10 grand lump sum payment, 10 grand comes off your mortgage, all right? But if you do 10 grand of regular repayments, it's a mixture of principal and interest, and it's mostly interest for a large proportion of your mortgage. So we want to bypass that, and we want to focus on doing lump sum payments because they're 100% principal. So this means you can live the lifestyle that you have chosen while still paying your mortgage down quickly and effectively. All you need to do is be intentional with some of your income, which is your seed capital, put that aside. The rest of your lifestyle stays the same, but you still get this pile of money at the end of each year, which you can use to do a lump sum payment onto your mortgage. Now, after doing each lump sum payment, you can keep your regular repayments at the same level, or reduce to minimum if your servicing ability is getting restricted. But for most people, if you've been able to, you've been paying those regular repayments up to now, you do a lump sum payment, then it's in your interest to actually just keep your repayments the same going forward. Okay, so as you do each lump sum payment, your mortgage actually gets smaller, of course, and you could do smaller repayments, but it's in your interest just to keep the same repayments going forward. The same goes for interest rate decreases. If there's interest rate decrease, then usually I'm in favour of people just keeping their repayments at the same level going forward, so that they'll just be paying off extra principal with their regular repayments. Okay, so annual surplus is basically just going to be your monthly surplus times 12. That is going to be your annual surplus. Okay, so question, can I just increase my regular repayments? So you can, but doing this has its limitations. So to get the same result in your fast track mortgage plan, you'll need to increase your repayments to such a high level that there is no margin for error with your lifestyle, right? So if life throws you unexpected expenses, you can easily get yourself in trouble and be short of cash because you've got such high regular repayments. So for example, you might start off with a 30-year mortgage, and if you said to yourself, I want to pay this off in 5 years, you're going to have to increase your regular repayments to such a massively high level and be committed to those payments, because you can't just go changing them whenever you want, but be committed to really high payments, and then you're going to get yourself in trouble if life throws some unexpected expenses at you. Now, by doing more regular sized payments and saving up big lump sum payments, you're not putting so much pressure on your cash flow, but you still get the benefits of doing large lump sum payments, so you can still get as good, if not better, result by doing the lump sum payment method. So by doing low regular payments and big lump sum payments, you don't have mortgage payment pressure on you. You can focus 100% on big lump sum payments. So increased regular payments are also not so great if you want to become a property investor, because it uses up too much of your income, and this can make it difficult for you to get finance for additional properties. Okay, so there has been multiple times when I've come across people that have increased their repayments to quite a high level, but then they want to go and buy an investment property, and the bank says no because too much of their income is going towards just paying their mortgage, right? So that's where, if you've got the intention of one day being an investor, you're actually better off keeping lower regular repayments and doing higher lump sum payments. Right, so lump sum payments move you down the table, which I'll show you an image of shortly, much faster, the mortgage table. So regular repayments can't be avoided, you still have to do them, but each lump sum payment moves you further along the table so that regular repayments start becoming less interest and more principal, way ahead of schedule. So this change takes effect from your very first lump sum payment and gets more effective with every subsequent lump sum payment. So this is what a table mortgage looks like. You probably might be familiar with this image. The blue part is the principal, which is the part that we like paying and the part that we want to get rid of, and all the white part is the interest. So if you look at these vertical yellow lines over here, these vertical yellow lines represent the mortgage repayments that you make, say, every fortnight or every month on a regular basis. So if you look at the very first yellow vertical line, you'll see that most of it is interest and just a little bit at the top there is principal. And then year 2, a little bit more is principal, but most of it is still interest. And year 3, a little bit more principal, but most of it's still interest. So you can see that you need to get down past about year 15 before you start paying more principal than what you do interest. And this is why banks are rich. Banks are rich because they're really good at getting interest out of their clients, and they do it with table mortgages like this, and so that way they can collect a lot of interest and collect the interest first while you're paying the principal last, often in the last 10 years of your mortgage, between year 20 and year 30. So if you look at these loopy jump things here, this is what happens every time you do a lump sum payment. Every time you do a lump sum payment, you move yourself down the table faster. And so you get the benefit of that lump sum payment, of course, because a chunk comes off your mortgage, but you get the added benefit of now you're moving further down the right of the table, and it means that your regular repayments start becoming more principal and less interest way ahead of schedule. So that means you're now winning in two directions. You're winning because of lump sum payments, and you're also winning because your regular repayments are a much higher proportion of principal and a lower proportion of interest. Right, exciting, right? I'm excited. I hope you're excited. All right, lump sum payments. So exercise 2 in your worksheets. What are 3 benefits of making lump sum payments on your mortgage? This is really important. Write it down. Make it sure it's really crystal clear in your minds that you understand why it's important, because this is going to change your financial position if you get in the habit of doing annual lump sum payments with your seed capital. Right. And anyway, I'm going to give you the answers now. Anyway, there they are on your screen. You pay less interest overall because you have less principal. You build equity faster. Equity is wealth, so we want to build equity. And you also can reduce your servicing costs if you choose to. But it certainly makes it easier for you to borrow for investment properties if your servicing costs stay relatively low and you are focusing on big lump sum payments. Right, next section, we're going to look at revolving credits and offset accounts. Now, just brief note on this, you don't have to use revolving credits or offset accounts, all right? Just think of them as a place for you to accumulate your surplus, your seed capital. You can accumulate your seed capital in a mattress under your bed if you want to. You can accumulate it inside a safe. You can accumulate it at your mum's house, whatever you want. But if you accumulate your surplus against your mortgage using a revolving credit or offset account, then you're going to pay less interest as you accumulate, right? Use that. So your fast track mortgage plan has been created using a revolving credit or offset account. So when used correctly, you pay less interest. Okay. So the revolving credit or offset loan is where you accumulate your monthly or your annual surplus, but you don't have to. It's just better if you do. Okay. You can use either revolving credit or offset loan. Choose the option that you prefer and the one that fits your money habits the best. So I'm going to go through these shortly, and then you will know yourself probably quite quickly which one is likely to be the better option for you. So revolving credit, your lump sum payment is accumulated in your revolving credit loan account, and then you pull this out each year for a lump sum payment. With an offset loan, you accumulate your lump sum payment in a nominated bank account, and you pull it out each year for a lump sum payment. So I'll have a couple of images for you shortly which will help you understand those better, so stay with me. So revolving credit features, you only pay interest on the outstanding balance, so the more you save, the lower your repayments are and the less interest you will pay. Can be harder to track the amount of your lump sum payment or your seed capital, as funds can easily get mixed up with funds for other purposes. So let's say you've got you're accumulating 10 grand a year for your lump sum payment, but you're also accumulating money as an emergency fund, and then you're also accumulating money for a car replacement. Well, it's all lumped in one bank account. It can be difficult to track what belongs to what, okay? Because it's all just basically one bank account. So income and fixed expenses can come into and out of this account. So revolving credits are transactional accounts. If you want to have your salary paid into a revolving credit, you can. Okay. If you want to pay your mortgage and your rates and your insurance and your power out of your revolving credit, you can. Okay. Revolving credit is better for people with higher financial discipline and control. Main reason for this is what I mentioned before. Your money for different purposes, it's getting mixed up in this one account. And then I have come across people that still like live out of this account. They'll do their groceries out of this account. They'll go and buy their coffees out of this account. If they want to go buy some clothes or shoes or a jacket, they'll do it out of this account, and I don't recommend doing that. Okay, so I recommend that funds should be moved each week to a lifestyle account to do your shopping and your living from. So that way you've got a parameter around how much money you're actually going to spend on that discretionary type spending, because often revolving credits can accumulate quite large sums of money, and then it's hard to track how much have I got to spend each week on discretionary spending. I've also worked with quite a lot of people who like to use their credit card for discretionary spending, and look, this technically can be done. You can use your credit card for that type of spending, but if you're moving your discretionary spending into a particular bank account, then that's the only money that you've got to spend on discretionary spending. If you move your money if you're using a credit card for your discretionary spending, you might have a $5,000 limit on that credit card or a $10,000 limit on that credit card. Much lower rate of success with people that use their credit cards for discretionary spending because they can't track it, and often they've got big credit card limits. Often they're using it to get air points. Believe me, or trust me, if you are using your credit card to chase air points, then you're the sucker. All right, because generally what people do is that you will use your justify purchases to get more air points because you think you're winning with your air points. All right, they're just getting you because you're paying more for more stuff that you don't need. So I don't really advocate for people chasing air points and those types of loyalty schemes, because they just encourage spending, and especially in credit cards where you might have $5,000, $10,000 limits on credit cards. It's very hard to control how much you're spending, and in your mind, spending is good because I get air points, okay? But whoop-de-doo, all right? Just save up and buy your airline tickets, okay? It's just so much easier, safer, and it gives you much better financial habits and practice. So on screen here, you have the revolving credit example. So I'm going to show you a revolving credit example and an offset example. They're both got $350,000 mortgages, and so you'll be able to compare the two. So here in this revolving credit example, you'll see here at the top, $350,000 mortgage, and there it is there. And then we've got a revolving credit of $50,000, and then down the bottom we've got $100,000 on 1 year fixed, $100,000 on 2 year fixed, and $100,000 on 3 year fixed. So you'd start at point A, and this is where you'd try to accumulate your seed capital, and basically all through the year you'd save from point A to point B, and that might be a 12-month period there. You might have money in here being saved for other purposes as well, other than just your lump sum payment. And then at the end of 12 months, you would pull that money out down to point C and do your lump sum payment onto your 1 year fixed loan. Okay, and then in year 2, you would do the same thing. You would save from point C to point D, and then you'd pull the money out to point E, and at the end of year 2, you do a lump sum payment onto this loan down here, and so on and so on. You just keep repeating that process, accumulate money, pull it out, and knock it down. Now, you see here that you can have your fixed expenses going directly out of the revolving credit. You can have your income over here coming directly into the revolving credit, so it can all be there in the one account. And then if you're going to use this method, I recommend having a separate bank account over here, and you have a weekly automatic payment going into this account. And this is money that usually is for things like groceries, petrol, entertainment, because these are the three main things that you might need cash for on a week-to-week basis. And for example, if you put $500 a week into this account here, then you have $500 for groceries, petrol, and entertainment. You'll just go back to your annual spending plan to work out how much you need going into this account to cover your weekly expenses. Now, revolving credits, I'll just talk about the interest rate issue with revolving credits. So the point of having the right size revolving credit is so that you can pay hardly any interest on it. So you might look at this $50,000 revolving credit, and you'll see that on internet banking, the interest rate is higher, much higher than fixed loans. And you might say, why would I want to have that money or have so much on my lending on my revolving credit because I'm going to pay higher interest on it. Now that's true if you never accumulate any money in your revolving credit, but that's not your plan. Your plan is to accumulate money in your revolving credit. So if we pretend that your revolving credit has got a 4% interest rate, which is quite high by current standards, if you save from point A to point B, you're only paying interest on your outstanding balance as you accumulate that money. And so what that means is that your true interest rate is actually roughly half of 4%. So if it's 4% on paper or on internet banking, in reality, you're paying about 2% in interest because you're only paying interest on half of the $50,000 revolving credit because you're saving $50,000 throughout the course of the year. Okay, so the right size revolving credit actually means that this part of your mortgage is actually the lowest interest rate, not the highest. It might look the highest on paper, but in effect it's not. It's actually the lowest, provided you have the right size revolving credit and provided you actually save money according to your plan, according to your seed capital plan throughout the 12 months of the year. Right, that was revolving credits and the revolving credit method. I'm now going to show you the offset loans method. So this method is better for people that like keeping their money in different pots, right? Different bank accounts. So remember that we talked before about revolving credits, how all the money's in one account, and that can be confusing. Offset loans solves this problem. It's in different pots or in different bank accounts. So you can automate the creation of your lump sum payment by having a regular AP transfer from your income account to your lump sum payment account. I'll show you an image of this shortly, and you'll understand that better. Less self-control is required because it's much easier to automate. Okay, and your regular repayments stay the same regardless of how much funds you have in your offset linked bank accounts. I'll explain that a bit more again shortly. So this is the offset example. This is the same $350,000 mortgage that we had before. And you'll see that with this version here, we've still got a $50,000 offset loan. But this is not like a revolving credit. You can't put funds directly inside it. It's basically just a standard principal and interest floating loan. Okay, so there's nothing fancy about it. It's just a principal and interest floating loan. And then over here on the right, you'd have these different bank accounts. You can have multiple bank accounts over here on the right, and these bank accounts are linked to the $50,000 offset loan. And so the more money that you have inside the bank accounts on the right, the less interest you pay in the $50,000 offset loan. And this is how you get the benefits. So your repayments on the $50,000 offset loan are based on a $50,000 loan. So let's say your repayments are $200 a week, for example. Now, even if you've got $50,000 in your bank accounts over here on your right, your repayments over here will stay around about $200 a week, okay? But those repayments will now become 100% principal because this loan is 100% offset. So you can basically, every $200 that you pay per week is just going to be 100% principal, and that loan will come down quite fast as a result. So that's the power of offsetting with the offset example. And then you'd have one bank account here, which you see this bank account I've called lump sum payment account. You could call it your seed capital account, whichever term you're comfortable with. And you would accumulate your seed capital into this account here. And then once a year, you would take that money and do a lump sum payment onto the 1 year fixed loan. And then the next year, you do another lump sum payment onto the 2 year fixed loan, and so on and so on. So you're still making your annual lump sum payments. You're still taking big chunks out of your mortgage. But now you have the benefit of having these different bank accounts, so you can see really easily that you're accumulating the right amount of seed capital for your annual lump sum payment. So this picture here is a really important picture. So have a really good focus on this and make sure that you understand this. So we've got here on the left, you've got your offset loan, and then on the right, you've got the different bank accounts that you can accumulate in, and you can have multiple bank accounts. You choose how you want to split them up and how you want to label them. But with this method here, you'd usually have your income coming into one account, and then you'd have automatic payments with the money going off to different bank accounts for different purposes. Okay, so say for example, if your aim was to accumulate $150 a week for your lump sum payment, then you'd have an automatic payment of $150 a week into this bank account here, and you know that would be $7,800 at the end of the year, and that would be then you know that you have $7,800 for your lump sum payment at the end of the year. You have some money for an emergency fund. You might have some money going for car replacement. You might have a bills account. I think nearly everyone needs to have a bills account. This would be where you pay your mortgage from, your rates, your insurance, your power, etc. Money all coming into that bills account. A holiday account, and then you might have a spending account for if you're a couple, one spending account for one person and one spending account for another person, for example, or you can spend out of the same account if you want to for discretionary. I'm a big fan of making sure you do have some allocated discretionary spending, because otherwise you might feel like there's no fun in your life, and it's important that you have some fun in your life. And so that's why having a spending allocation is really important. So you remember that in one of the previous modules I talked about the left brain people and the right brain people, and how the right brain people hate tracking their spending, and they hate having to track every transaction that comes in and out of their bank account. They hate using those apps that help you do that sort of stuff. Well, that's I think I explained earlier, that's the kind of person that I am, and I like using this type of system here. This is what I've got my eldest son doing. His income comes in like this, and then he splits off his money into 5 different bank accounts. So he doesn't have a mortgage, but he still sends off his money into different bank accounts for different purposes. So he's young, he's still trying to save for a car, he's trying to save for music gear. He's got a giving account, he's got a spending account, and he's got a savings account. So that's my son. He's only 16 years old. He's got 5 different bank accounts, and it goes off to these different purposes. So then at a glance, he can see how much he's got in those bank accounts for each of those different purposes. Now, if you're the right brain type person like myself, and you don't like tracking every dollar, then just set it up like this. Okay. Now, it might mean that you've got to change banks, because not every bank offers this. But that's something that we can talk about in a one-on-one session after you finish the course, about whether doing the offset method is better for you. But I can say to you, hands down, after teaching people both ways for nearly a decade now, the people that use this offset method get better results. Okay, and I believe that the reason that they get better results is because they have clarity over their bank accounts. They have clarity through automations happening, and they don't really have to think about it. They just probably have to spend 2 or 3 hours at the very beginning setting up these automatic payments and making sure that enough money is going into each account, and that the bills are getting paid at the right time and all of that. So there's a bit of a job to set that up, probably a 2 or 3 hour job at the beginning to set this up, but after that it takes care of itself, maybe just with some minor tweaking. All right, but you can get this running like a well-oiled machine, so that it's set up, you've got money accumulating in your lump sum payment account, and every year you do a lump sum payment, and bang, you are paying your mortgage off faster. I've worked with multiple people that have been using the revolving credit method, weren't getting the results that we desired, move them onto this method here, and bang, awesome results. All right, so I'm a big believer in this. This is now my preference. Okay, if you are left brain, really great at tracking your spending, and you like doing that, then certainly you can use the revolving credit. It does work just as well, but in my mind the clarity isn't there, and considering probably half the population are more right-brained, then it makes sense that a lot more people are using this method, and then even within couples you might have one person that's left and one that's right, and the right brain method, which you see on screen right now, is fine for left brainers and right brainers. They can both make this work, but the revolving credit method really, I find in my experience, has only really worked well for left brain people. So I'm a big fan of this. Set up your APs, get your money going into different accounts, and this is a way that you don't have to track your spending day in, day out. You just have to look at your spending account, and then you know how much you've got to spend that week. Right, and you can look at your lump sum payment account, and you know, great, I'm on track. I can sleep well at night because I know that I'm winning, and I'm on track to do a good lump sum payment at the end of the year. At a glance, you can see where you're at, and there's so much satisfaction and so much peace of mind that comes from knowing you're on top of it. Right? right? Because if you know that you're winning financially, you know you've got a plan in place, and you can just take a glance at internet banking and see that basically everything's under control. There is so much satisfaction on that, and I've seen this where I've had people basically almost burst into tears because they are so happy that they have got this under control and they feel a sense of financial control that they never felt before. Okay, so this is something that I encourage you to talk about in the one-on-one session after the course. Make sure that you are on the right method and the right pathway to get the result that you want to get. Okay, so revolving credits and offset accounts. Question: revolving credits and offset loans are on the floating rate. Will this mean I pay more interest? No, this I did mention this before already, but if you have the right size revolving credit or offset, not if you have the right size revolving credit or offset, if you have the right size, your interest rate for this loan will be roughly half of what it is on paper. It will actually be the part of your mortgage that you pay the least amount of interest on. You have to ignore that interest rate that you see in internet banking. Provided you're accumulating your money, you will pay very little interest on your revolving credit or offset loan, provided you have the right size. Okay. Now, how to work out the correct size for your revolving credit or offset? So this is the formula. You're going to look at your current savings. You're going to look at your annual surplus. So this is your seed capital, annualized. You're going to look at any other savings that you might have, such as, say, car replacement, home account, emergency fund, okay? And that will equal your revolving credit or your offset limit, okay? This will ensure that most of your, offset loan is actually being offset, or revolving credit is actually being offset. And as a result, you pay very little interest in that account. You just have to do this formula here. And so this is actually the starting point for your revolving credit, the starting point for your fast track mortgage plan. Everything hinges off this. You're essentially, if you've got a $500,000 mortgage, what I'd be doing is and this is what Fast Track Mortgage Plan does, is that it works out how big your revolving credit or offset loan should be, and then the rest of the lending basically falls into place after you work this out first. Okay, so you'll see that on your Fast Track Mortgage Plan, we'll have a recommendation there for how big your offset or revolving credit should be, and then the rest of the lending falls into place after that. Right, number 4, hedging. So some of you might be familiar with hedging, but if not, we'll just go through it now. It's a pretty simple concept. So after working out the correct size of your revolving credit or offset, the balance of your mortgage can be hedged. So we hedge so that you can make lump sum payments each year without penalty. We also hedge to split our risk over different time periods. So in the current climate, hedging over 3 years or even 2 years is fine, but traditionally I've normally done a 3-year hedge, which means a 1-year fixed, a 2-year fixed, and a 3-year fixed. And I think I've got an example of this shortly, but basically you would have your revolving credit or offset, and then the rest of the lending you would split, say, into thirds and have a third of it on 1-year fixed, a third on 2-year fixed, and a third on 3-year fixed. The reason that I'm saying 2 years is kind of okay in this current environment is just because I think we live generally in a world of low interest rates at the moment, and so it's maybe not quite as important as what it has been in the past to split your lending up into different portions to lower your risk. I think that generally rates should stay pretty low for the next few years, but certainly the safer option is to do more splits, such as a 1-year, 2-year, 3-year fixed. Right, so need an emergency fund. So some people use their first year's lump sum payment to accumulate an emergency fund. At the end of the year, instead of doing a lump sum payment, you just increase the size of your revolving credit or offset loan to accommodate this. You don't need additional lending to make this happen. Some debt is just taken from the P&I fixed loan and added to the revolving credit offset to increase the limit to accommodate 2 years worth of savings. So this is just a way of you accumulating emergency fund. Emergency funds are important. I usually recommend 3 to 6 months of your living expenses so that you have this money put aside, so you could use your first year of your seed capital to be your emergency fund if you don't have an emergency fund in place currently. Right, so exercise 4. How much would you need for a 3-month emergency? So scenario, the highest earner in your household in your household is ill and unable to work for 3 months, what is the estimate of 3 months living expenses for your household? So this is where you might go back to your annual spending plan and look at what are the bills that you have to pay, your mortgage, your rates, your insurance, your food and groceries, etc., and figure out how much money would you need for 3 months, and then that would tell you how big your emergency fund should be. Right, and then if you want to make it more robust, then you would make it longer than 3 months, 4, 5, 6 months, so that you've got a larger fund. That's right. So the wrap. Let's summarize. Earn the most that you can. Live to a spending plan in order to create a monthly surplus. Accumulate your surplus in a revolving credit or offset loan of the right size, or bank account linked to your offset loan. I think you guys get that now. Have the balance of your loans in a hedging strategy. So that's a 1 year, 2 year, 3 year fix, for example. Pull your annual surplus out each year and do a lump sum payment, and then refix your loan in accordance with your hedging strategy. So you'll see that in your fast track mortgage plan, we will come up with a scenario for you for the size of your revolving credit or offset. Plus, we'll suggest a hedging strategy for you, and then this is something that you would talk about in your one-on-one session about whether that needs to be adjusted. The reason that sometimes it does need to be adjusted is that because people might have money in a separate bank account, sometimes at a separate bank, which is like their emergency fund or their savings, and that's money that we might now use to offset instead, and as a result we might need to increase the revolving credit or offset loan as a result of that. So I just did that for someone just last week. In fact, they banked with one bank, but they had savings in another bank, and once we pulled that savings back to offset against their mortgage, we had to increase the size of their offset loan. Now, once you have enough usable equity, you are ready to invest. Okay, so this is one of the next steps of building wealth, because basically we do want to have the right side, the right mortgage structures for your situation. We want to build equity fast, but then we want to do something with it. We want to invest, and of course, because we're mortgage advisors and we work with property, we're often encouraging people to invest in property, and there's lots of advantages to doing that. But there is other things that you can invest in as well. So just briefly, in terms of investing in property, I'm a really strong believer in investing in new build property as your investment property. New builds, right? Why new builds? Because one, you're not stealing houses from first home buyers. Those first home buyers, they're still trying to buy their first house. Why don't we give them a chance? If you're out there buying the houses that they're trying to buy, then you end up having 2 houses and they have no houses. So just in terms of feeling good about helping New Zealand society, and we want people to be homeowners, I encourage people not to buy existing houses, but to help solve New Zealand's housing problem, which means we can take responsibility for building a new house. Now, once you've had that new house built as an investment property, it's better for you anyway. Why wouldn't you do it? Think of this. It's double glazed. It's insulated. It's got heating in it. It now meets Healthy Homes requirements that you have to meet as a landlord. On top of that, it is easier for you to tenant that property because it's a nice brand new property. It's easier to find tenants, and you can probably charge a slightly higher rent because they'd rather live in your house than one of those older houses, right? And then lastly, you've got hardly any maintenance probably for the first 10 years. Like, why do you want to be doing maintenance for? Get an older house from the 50s, 60s, 70s, 80s, 90s, you got to spend more money and time and effort maintaining that property, and you get more phone calls on the weekend from your property manager telling you that the tap's broken, or this is broken, or that's broken. Get a new house, less hassle, right? So there's another reason there that there's just less maintenance, less hassle because it's new. Okay. Now, once that new house, we're talking 10 or 20 years down the track, starts having some maintenance issues, if you really want to, sell it and buy another new one at that time. Okay. But there's so many advantages to buying new builds as your investment properties, and this is something that we coach people and help people to source their properties so that you don't even have to look hard to find the properties. We show you how to find them, and then it's such a nice, easy, dignified process of buying your investment property because we can put it on a plate for you. All right. So adjust your mindset around your income and expenses. So commit to living on less than what you earn. Commit to becoming a saver and a payer of lump sum payments. Commit your mind to the result that you want to achieve. follow your plan to get the result. I hope you found that exciting. Basically, you do the stuff here in Module 5 and you will become wealthy. All right, and all you need to do is commit to putting money aside for your seed capital, commit to having the right mortgage structures, commit to building equity with lump sum payments, and then commit to investing after that. It's really 3 really simple steps, and if you do that, your family will be financially changed for forever going forward, pretty much. All right, it's just so easy to actually play this wealth game. You just need to get a few simple steps right. And then just basically as a reminder of our leaps and bounds process that you see on the screen, I did mention this previously, but if you've got young up-and-comers in your family who are wanting to get started, children or nieces or nephews, or maybe it's even you, then this is what we consider to be a good pathway to follow to build your wealth. Number 1, save $1,000. Why do we do that? Because you need to have a small victory early, all right? So basically we want to have a small victory, which is we've got $1,000 put aside, which essentially is your beginning emergency fund. Okay. Number 2, we're going to pay off short-term debt. You're going to go and grab, if you've got short-term debt or the people you're thinking of have got short-term debt, then go to our website, download the Debt Crusher PDF, learn the different strategies for paying off short-term debt and employ them. I'm a big fan of the debt snowball, and we want to get rid of short-term debt. Short-term debt is bad because it takes up too much of our income, and we don't want to be paying rent on money. We want to be able to use our income to grow our wealth, not grow other people's wealth, right? Other people's wealth. So that's why we want to pay off short-term debt and don't get into that habit. By the way, just touch on this. If you're playing around with short-term debt and you say to yourself, oh, but I was paid off within the interest-free period and it's harmless and I'm playing them, they're not playing me. I just want to challenge you on that and just say essentially what you're doing, pretend you're down at the local pool, and you know how they've got those big water slides down at the local pool? Basically what you're saying is that I'm just going to go down the first little bit of the slide, right? I'm just going to play at the top. It's bad to go all the way to the bottom. I'm not going to do that. I'm not silly. I'm just going to play at the top of the slide. Now, the problem is, once you start going down that slide a little bit, it's hard to stop, right? And when you play around with credit cards and short-term debt, even if it is interest-free, even if it is getting you air points or the similar, you're basically playing at the top of the water slide, and you're basically encouraging yourself to use other people's money to solve your problems. I really want to impart on you, take responsibility for your financial life. Don't use other people's money to solve your problems. Use your own money to solve your problems with some planning. It's easy, okay? Number 3, you're going to save your emergency fund money. So this is the 3 months expenses that we talked about before, and more if you want more. But if you find that you're without a job, you'll be very, very grateful that you took the time and effort to save an emergency fund. Okay, 4, if you haven't bought a house yet, you're going to save 10% for a house deposit between KiwiSaver and cash. If you've got a house already, then fantastic. But if you haven't, you're going to save 10%. You're not going to try to save to 20%. You're going to save 10% and then come and talk to us so we can show you what to do next. With 10%, you'll be fine. We'll get you into the market. All right. Number 5, we're going to buy a house. Number 5 is in the middle, because once you've done that gearing up phase, steps 1, 2, 3, and 4, and then you buy a house at number 5, you are really ready. You are really ready to launch. You now have a platform, because with a house, you can create equity, which is wealth, and from there you can invest. Okay, so that's where we get to number 6. So this might be where you are right now. Number 6, you might just be learning how to pay your mortgage off faster and to build equity. All right, that's what your fast track mortgage plan is, to show you how to pay your mortgage off faster and build equity. Number 7, after that, you're going to invest in property and or shares. We recommend property because you can 100% leverage, but this is a personal choice. And you are right now in the middle of the acceleration phase or the accelerating phase, and this is where you can really grow your wealth position. Okay. Number 8, you're going to pay off your owner-occupied mortgage and do that as fast as you possibly can to create equity. And then number 9, you're going to build wealth and be generous. All right. Generous people are likable. Likable people get more opportunities. Okay, simple as that. And we live in a world of massive opportunities, but they're not going to come to you if you're not generous and getting yourself out there and being seen as being a likable person, because as a likable person, you'll find that opportunities just keep coming in your direction. And good opportunities can make you hundreds of thousands of dollars, if not millions of dollars. So I'm not saying be generous to get rich. I'm saying be generous because that's a great thing to do, and it builds your own character, makes you a more likable person, and if you want your kids to be kind and generous people, then model that to them, and then they will learn from your example. Right, that's all now for Module 5. I hope that you've enjoyed that. I really have enjoyed teaching this session to you guys. I hope you can see that I get a little bit excited and a bit passionate about it, because I really love showing people how to kick their mortgage to the curb, and that really does lay the platform for you growing your wealth position. So write down any questions that you've got. You've got a note section there in your workbook. So get that all written down, and look forward to going through any of that with you in the one-on-one session. But otherwise, have a great day, and we'll see you for our last module, which is next, which is Module 6.